For years, I have shied away from Chinese companies until recently when Baba went on sale. Baba had gone 50% decline from its highs of $300 a share. To my valuation, at least to my opinion, this is indeed a good deal. And therefore, off I went and bought my first shares of a Chinese company ever. Buying a Chinese stock is not like buying a regular share. With Chinese stock, investors buy ADR or American Depositary Receipts. ADR was created because buying a foreign stock is remarkably complicated. ADR makes the entire process somewhat less complicated. Therefore, when you buy Baba shares, you do not directly own Baba shares. What you own is ADR, which then turns as VIE or Variable Interest Entity. Hence, buying Baba shares is not comparable to owning common shares. ADR is somewhat riskier. I do not want to go into the nitty-gritty details of the VIEs and the ADR. What I would like to focus on in this video is my valuation and why Alibaba is indeed a good long-term investment, at least to my opinion. You then might ask yourself, the Chinese government as risky as it already is, and then plus the risk that ADR brings, what then on earth was I thinking buying Baba shares? Which I would say is a legitimate question. In order for me to answer that, I will have to provide you some numbers. Alibaba is the world's largest online and mobile commerce company in fiscal year ended March 2020, measured by GMV, or gross merchandise value. Gross merchandise value is the total value of merchandise sold over a given period of time. Amazon's GMV in 2020 was recorded at $475 billion, whereas Alibaba's GMV fiscal year ended 2020 was recorded at a staggering 1 trillion US dollars. Alibaba was more than 2 times Amazon's GMV in 2020. Alibaba operates China's most visited online marketplaces, including Taobao and Tmall. Taobao is a consumer-to-consumer online marketplace, and Tmall is a business-to-consumer marketplace. Alibaba's China Commerce Retail Division accounted for 69% of revenue in December 2020 quarter ended, with Taobao generating revenue through advertising and other merchant data services, and Tmall deriving revenue from commission fees. Alibaba's additional revenue sources include China Commerce Wholesales, international retail, wholesale marketplaces, cloud computing, digital media and entertainment, CAINIAO logistics services, and innovation initiatives. As you may have noticed, Alibaba's revenue stream is diverse and expansive. Therefore, if one industry in the global market experiences economic and financial crisis, there are other revenue streams Alibaba can rely on to, and this is an extremely important factor. Alibaba is not just an online retail company. It has 13 major businesses with 1.18 billion annual active consumers by middle of 2021. These active members are from China and overseas, mostly from the Asian continent. Alibaba also competes with Amazon's Web Services and Microsoft Azure. As I have mentioned already, cloud computing is one of Alibaba's offerings. Amazon Web Services reported a year-on-year revenue increase of 29%, and Microsoft Azure grew 48% in September. Meanwhile, Alibaba reported a staggering 60% year-on-year rise on cloud computing, which brought in a revenue of $2.24 billion in the 3 months that ended September 30th, 2020. I must point out, though, that it was not only by the end of 2020 that Alibaba cloud computing became profitable. Alibaba Cloud is an incorporation of various Internet of Things services. In 2019, Alibaba Cloud was the third largest publicly traded cloud company in the world next to Amazon and Microsoft. This table is Alibaba's revenue record since 2016. As you can see, it is on upward trend. This table is Alibaba's balance sheet. It is a very strong balance sheet where its assets are almost 3 times bigger than its liabilities. The company's sales grew at a remarkable rate of 60% on average in the last 10 years. The earnings per share grew at 56% in the last 10 years as well. Even the return on invested capital and return on equity has been recorded on double digits in the last 10 years. This table is the comparison of Amazon and Alibaba revenue since 2016. I have input these numbers into an Excel sheet as you can see here for a better and clearer comparison. This is the revenue growth. This is the year from 2016 until trailing 12 months. This is for Baba and Amazon direct comparison. These are the revenue recorded in 2016 for Baba, and this is for Amazon. Looking here at 58%, Alibaba grew its revenue in 2017 at 58% compared to Amazon, which grew its revenue at 31%. Looking in 2018, Alibaba grew at 52% and Amazon grew at 31%. And this was the pattern of both these companies until the trailing 12 months. What is remarkable with both these companies is that their growth of revenue from 2017 until the trailing 12 months were both depleting. Alibaba started at 58% and a trailing 12 months of 19%, whereas Amazon started at 31% and the trailing 12 months of 15%. But when you look at the average growth of revenue of Alibaba since 2017, it is recorded at 41%, and Amazon is only recorded on average at 27%. Therefore, Alibaba's revenue grew 1.5 times faster than Amazon. By the way, the tool that I'm using for my valuation is called StockRover. If you like what you see, you may click the link on the description below. You will certainly receive a 2-week free trial of this tool. Going back to the comparison between Alibaba and Amazon, the GMV of Alibaba was recorded to be higher than Amazon. And with the recorded growth of revenue since 2016 and even 10 years ago or in the last decade, on average, Alibaba's growth revenue has been recorded to be higher than Amazon. Even then, the stock price of Amazon surged from $676 at the end of 2015 to a staggering $3,400 as of the recording of this video. That's more than 5 times increase, whereas if we compare this to Alibaba during the same period, Alibaba was trading at $81 a share to $168 a share during the recording of this video. With all of these positive numbers, with all the growth prospects, innovation, research and development, what could possibly go wrong with Alibaba? And the answer is the Communist government of China. I have made a video specifically focused on the possible effects of the Chinese government regulations and tightening of the power and influence of corporate China. If you want to know more about this video, I will link it in the description below. The truth of the matter is that China still is a capitalist country. The leaders of the government do understand the importance of business. The ultimate goal of the country is to be the leading and most powerful economy in the world, and this can never be achieved if business, such as Alibaba, is stifled for growth. Alibaba is stable. It is growing. the company's revenue streams are diverse, it is also cash rich. There is no question to this. The more important question you have to ask yourself is your level of tolerance to the volatility and risks of the Chinese economy.
Thank you very much indeed. I hope that you enjoyed this video, and I hope that you gained value from my video and my channel as a whole. If you did, please share, like, and subscribe, and I certainly hope to see you on my next video.